September 26th, 2025. The Shanghai Gold Exchange makes an announcement that should have set off alarm bells across every trading desk on the planet. Silver margins hiked to 19%, not a modest adjustment, a 17% increase. And here's what nobody's telling you. This was the sixth margin increase in 2025 alone, 6 times in 1 year. That's not risk management, that's panic control. While financial media discusses whether silver hit $60 or $63 per ounce today, December 15th, they're missing the real story. The physical market is breaking. Right now, Shanghai's margin hikes aren't about protecting investors. They're about preventing a delivery crisis that could expose the entire paper silver system as a house of cards built on promises nobody can keep. Let me show you what's happening in Shanghai, why the 19% margin requirement is a massive red flag, and why the timeline suggests we're not months away from a crisis, we're weeks away, maybe days. The Shanghai margin story starts in September 2025. Silver was trading around $44 per ounce. Then the Federal Reserve cut interest rates. Money flooded into hard assets. Silver exploded. And the Shanghai Gold Exchange watched their traders lever up positions they couldn't possibly deliver on if things went sideways. Here's how margin works. When you trade silver futures, you don't put up the full value. You put up a fraction. If silver is $50 per ounce and margin is 10%, you need $5 to control $50 worth of silver. That's 10-to-1 leverage. Exchanges set margin requirements to prevent cascading failures when prices move violently. Normal margin requirements for silver? Around 10 to 13%. But when Shanghai raised margins to 19% in September 2025, they were sending a message. We're terrified of what happens if this gets out of control. Because 19% margin means traders need nearly 1/5 of contract value. That's not leverage, that's near cash settlement. It kills speculation and prevents the one thing exchanges fear most, a delivery squeeze, where everyone demands physical metal and there is not enough. But here's the terrifying part. This was the 6th margin hike in 2025. Not the first, the 6th. In early September, margins were at 16%. They jumped to 17%, then within weeks, 19%. That's not gradual risk management. That's emergency intervention. Now, I know what you're thinking. Exchanges do that all the time when volatility spikes. Why is this different? Because it's not just Shanghai, it's global, and it's all happening at once. October 17th, 2025. The Shanghai Futures Exchange announces they're raising margins from 13% to 15%. They also expand the daily price limit from 12% to 14%. Translation: silver is moving so violently that normal trading limits can't contain it. When multiple exchanges in the same city raise margins simultaneously, that tells you something systemic is happening. And what they're seeing is this. Physical silver is disappearing from vaults, and paper contracts are multiplying faster than metal can be sourced. The Shanghai Futures Exchange reported warehouse stocks at 820 tons on December 12, 2025. Sounds stable, right? Except in January 2021, Shanghai held 3,091 tons, nearly 4 times more. The current 820 tons is barely 1/4 of 2021 levels. That's not stable inventory. That's a chronically drained system running on fumes. And while Shanghai's physical inventory dropped 75%, trading volume exploded. December 15th, 2025. Trading volumes hit the highest level since May 2024. Everyone wants silver exposure. But the physical metal backing those trades, it's not there. This is the classic setup for a squeeze. High paper volume, low physical inventory, and margin requirements spiking because the exchange knows if traders demand delivery, the system implodes. Now let's talk about why this matters globally. October 2025. Physical silver premiums in Asia hit $8 per ounce above Western spot prices. Normally, premiums are 50 cents to maybe $2. $8 means something is fundamentally broken. Asian buyers are so desperate for physical metal, they're paying 15 to 20% premiums just to secure delivery. And when Asian premiums spike that high, traders air freight silver from London and New York to Shanghai. Except there's a problem. London vaults are also running low. In October, reports indicated London nearly ran out of physical silver, actually ran out. The same month, Diwali demand in India spiked. The same month, Shanghai was raising margins for the 6th time. This is the global silver shortage in action. It's the entire physical supply chain being drained simultaneously from multiple directions. Industrial demand, investment demand, and strategic hoarding all at once. Let me show you the numbers. The Silver Institute projects a supply deficit of 187 million ounces for 2025. That's consumption exceeding production. This is the 5th consecutive year of deficits, 5 years where the world uses more silver than miners produce. Where's the difference coming from? Above ground stockpiles. And those stockpiles are being drained relentlessly. Cumulative deficit since 2021, nearly 800 million ounces. 800 million ounces pulled from above ground stocks over 4 years. And silver mine production is declining, down roughly 7% since 2016. Why? Because 70% of silver comes as a byproduct of zinc, lead, and copper mining. When base metal prices are weak, silver production falls. And you can't just open a new silver mine. It takes 10 to 15 years from discovery to production. This is inelastic supply. No matter how high prices go, supply can't respond quickly. So when demand surges, driven by solar panels, electric vehicles, 5G infrastructure, AI data centers, and investors fleeing fiat currencies, the only place demand can be met is from existing stockpiles. And those stockpiles are running out. Here's where Shanghai's margin hikes become the canary in the coal mine. The exchange cares about one thing: can they deliver physical metal if contract holders demand it? And the answer they're signaling with 19% margins is, we're not sure. So we're making it expensive enough to hold these contracts that most people roll them forward instead of taking delivery. Because if 10% of open interest demands physical delivery, they don't have enough metal. This is the fracture line. December 15th, 2025. Silver spot price trades at $63.91 per ounce, up over 120% year to date. That's the paper price. But try to buy physical silver in size. 1,000 ounces, 10,000 ounces. You'll find premiums of $5 to $8 above spot. Delivery delays of weeks. Dealers can't source that quantity at any price. Paper silver trades freely at $64. Physical silver is unavailable or carries massive premiums. The two prices are separating because the paper market is 50 to 100 times larger than the physical market. For every ounce of physical silver in a vault, there are 50 to 100 paper claims. As long as nobody demands delivery, it works. But when confidence breaks, when people say, I want the metal, not the contract, that 50 to 1 leverage becomes 50 people fighting over 1 ounce. And that's when prices go vertical. Shanghai's margin hikes are the exchange saying, we see the leverage, we see the inventory, we see the demand, and we're terrified. So we're making leverage so expensive that speculators exit before we face a delivery crisis we can't solve. But here's the problem. This only works if the shortage is temporary. If demand genuinely exceeds supply for years, if industrial consumption is growing faster than mining can keep pace, then raising margins doesn't solve anything. It just delays the inevitable. And when the inevitable arrives, it arrives all at once. Let me paint the scenario. Silver continues climbing into early 2026. Prices hit 70, then 80, then approach $100. Industrial users start panicking. They need metal now. So they stop trading futures and start demanding physical delivery. Investors trading paper silver see premiums widening and realize their paper contract is worthless unless they can get delivery. So they demand delivery too. Suddenly, instead of 1% of contracts going to delivery, 10% do, then 20%. The exchanges realize they don't have enough metal. So they do what exchanges always do in a squeeze. They change the rules. Margins go to 30%, to 50%. Delivery limits, restricted long positions, everything possible to prevent physical delivery. But unlike previous squeezes, this time it doesn't work because the shortage isn't speculative, it's real. Industrial users literally cannot manufacture products without silver. They're trying to keep factories running. And when industrial demand collides with an exchange trying to prevent delivery, something breaks. Either the exchange defaults on contracts and pays cash settlement, destroying confidence in the paper market, or they source metal at any price, sending spot prices to $150, $200, $300 as desperate buyers outbid each other. Either way, the system doesn't survive. We get a repricing, a recognition that paper silver and physical silver are two different assets. Now, I'm not saying this happens tomorrow. This is educational observation. But the pattern is undeniable. Shanghai raising margins 6 times in 1 year, London nearly running out, Asian premiums at $8, 5 consecutive years of deficits, 800 million ounces drained from stockpiles, inventories at multi-year lows, trading volumes at multi-year highs. These are verifiable data points, and they all point in the same direction. The physical silver market is under stress never seen before. Not in 1980, not in 2011. Because in 1980, the Hunt brothers were artificially cornering the market. This isn't artificial. This is structural. Demand genuinely exceeds supply, driven by technologies that didn't exist in 1980. Solar panels, electric vehicles, 5G, AI. Every major economic trend requires more silver, and there's no substitute. You can't make a solar panel without silver. These aren't luxury goods. They're critical infrastructure. And here's the final piece. The United States designated silver as a critical mineral in late 2025. Why? Because governments don't designate something as critical unless they're worried about supply. That designation triggered precautionary buying. Companies stockpiled silver before potential export restrictions. That removed even more supply from the global pool and created a geographic bottleneck. This is the Shanghai emergency in full context. It's a global supply chain under stress from every angle. Structural deficits, industrial demand, investment demand, strategic hoarding, geographic fragmentation, and exchange inventories at critically low levels. The 19% margin requirement is Shanghai saying, "We're trying to prevent our market from being the trigger that starts the cascade." But whether they can prevent it is another question, because the forces driving this shortage aren't going away. Solar installations projected to double by 2030, electric vehicle production growing 40% year over year. 5G build-out continues, AI data centers multiplying. The demand side is locked in. It's structural, it's growing, and supply can't keep pace. The timeline? Based on inventory burn rates and delivery stress, we're looking at 6 to 18 months before something gives. Not a crash, a break. A moment where the paper market diverges so far from physical reality that confidence shatters. Maybe it's triggered by a major industrial buyer demanding delivery the exchange can't fulfill. Maybe it's a sovereign wealth fund wanting physical metal instead of paper promises. Maybe it's just the slow grind of deficits exhausting the stockpiles. But the direction is set. The Shanghai margin hikes are the warning sign. The question is whether you're paying attention. Because when this breaks, it won't be slow motion. It'll be rapid, violent, and irreversible. Paper silver will be repriced, and anyone holding paper will learn an expensive lesson about the difference between a contract and a commodity. This isn't about predicting the future. This is about recognizing a pattern playing out right now. The only question is whether you see it coming or learn about it when prices are 10 times higher and physical silver is unavailable. If you want to understand who actually controls the world's silver supply and why that control is being challenged right now, I've got another video breaking down the entire structure. Understanding the Shanghai emergency is one thing. Understanding who benefits when that emergency becomes a crisis, that's the next level. Check out who really controls the world's silver, and you'll see why the players behind the scenes are positioning exactly the way they are. This story needs the full picture, and the full picture is being revealed right now whether most people are paying attention or not.